And this has been a wonderful period for us at GEICO because several of our major competitors have decided, and they publicly stated this. In fact, one of them just reiterated it the other day, although they now changed their policy. But they intentionally cut back on new business because new business carries with it a significant loss in the first year. There's just costs of acquiring new business. Plus the loss ratio, strangely enough, on first-year business tends to run almost 10 points higher than on renewal business. And so not only do you have acquisition costs, but you actually have a higher loss ratio. So when you write a lot of new business, you're going to lose money on that portion of the business that year. And we wrote a lot of new business, and at least two of our competitors announced that they were lightening up for a while on new business because they did not want to pay the penalty of the first year loss. And of course that's made to order for us, so we just put our foot to the floor and try to write as much business, good business as we can, and there are costs to that. A second factor, well, it's not a factor in the P&L, but an important event in the first quarter is that we increased our float. And on the slide, I believe it shows it year over year, 16 billion. 14 billion of that came in the first quarter of this year. So we had a $14 billion increase in float. And for some years, I've been telling you it's going to be hard to increase the float at all. And I still will say the same thing, but it's nice to have $14 billion or more, which is one reason. If you look at our 10Q, you will see that our cash and cash equivalents, including treasury bills, now has come to well over 90 billion. So I think I feel very good about the first quarter, even though our operating earnings were down a little. But one quarter means nothing. I mean, over time, what really counts is whether we're building the value of the businesses that we own. And I'm always interested in the current figures, but I'm always dreaming about the future figures. There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. There's I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it, Ben Graham even talked about it, but the truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, the index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him. And he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds. And we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time. So it's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors. And Jack, I've got great news for you. You're going to be 88 on Monday, and in only 2 years, you'll be eligible for an executive position at Berkshire. So hang in there, buddy. Okay, we've got a panel of expert journalists on this side and expert analysts on that side and expert shareholders in the middle, and we're going to rotate, starting with the analysts and somewhere here I have here we go. And we'll do this through the afternoon. If we get through 54 questions, which would be 6 for each journalist, 6 for each analyst, and 18 more for the audience, then we will go strictly to the audience. I don't think I've got any information as to what the situation is on overflow rooms, but we'll go to at least one of them. But let's start off with Carol Loomis of Fortune magazine, the longest serving employee in the history of Time Inc., I believe, with 60 years. And Carol, go to it.
Thank you. Thanks from all of us journalists up here. I know that there are many, many people out there who have sent us questions that aren't going to get answered. And I just want to say that it's very hard to get a question answered. The one thing I could suggest is you follow Warren's thought in the annual report that he wants everybody to go away from this meeting more educated about Berkshire than they were when they came. And one way you can do that is keep your questions quite directly Berkshire related or relating to the annual letter. Even then, it will be hard to get your question answered. The three of us only have 18 questions in total. But I encourage you to think in the Berkshire-related direction when you're submitting a question next year. Now, my first question. It's about Wells Fargo, which is Berkshire's largest equity holding, $28 billion at the end of the year. And this question comes from a shareholder who did not wish to be identified. In the wake of the sales practices scandal that last year engulfed Wells Fargo, the company's independent directors commissioned an investigation and hired a large law firm to assist in carrying it out. The findings of the investigation, which were harsh, have been released in what is called the Wells Fargo Sales Practices Report. You can find it on the internet. It concludes that a major part of the company's problem was that, and I quote, Wells Fargo's decentralized corporate structure gave too much autonomy to the community bank's senior leadership. End of quote. Mr. Buffett, how do you satisfy yourself that Berkshire isn't subject to the same risk with its highly decentralized structure and the very substantial autonomy given to senior leadership of the operating companies?
Yeah, it's true that we at Berkshire probably operate on this. We certainly operate on a more decentralized plan than any company of remotely our size. And we count very heavily on principles of behavior rather than loads of rules. It's one reason at every annual meeting you see that Solomon description, and it's why I write very few communiques to our managers, but I send them one once every 2 years, and it basically says that we've got all the money we need. We'd like to have more, but it's not a necessity, but we don't have 1 ounce of reputation more than we need, and that our reputation at Berkshire is in their hands. And Charlie and I believe that if you establish the right sort of culture, and that culture to some extent self-selects who you obtain as directors and as managers, that you will get better results that way in terms of behavior than if you have a 1,000-page guidebook. You're going to have problems regardless. We have 367,000, I believe, employees. Now, if you have a town with 367,000 households, which is about what the Omaha metropolitan area is, people are doing something wrong as we talk here today. There's no question about it. And the real question is whether the managers are in a better, are worrying and thinking about finding and correcting any bad behavior, and whether if they fail in that, whether the message gets to Omaha and whether we do something about it. At Wells Fargo, there were 3 very significant mistakes, but there was one that dwarfs all of the others. You're going to have incentive systems at any business, almost any business. There's nothing wrong with incentive systems, but you've got to be very careful what you incentivize. And you can incentivize bad behavior, and if so, you better have a system for recognizing it. Clearly, at Wells Fargo, there was an incentive system built around the idea of cross-selling and number of services per customer, and the company in every quarterly investor presentation highlighted how many services per customer. So it was the focus of the organization, a major focus, and undoubtedly people got paid and graded and promoted based on that number, or at least partly based on that number. Well, it turned out that was incentivizing the wrong kind of behavior. We've made similar mistakes. I mean, any company's going to make some mistakes in designing a system, but it's a mistake, and you're going to find out about it at some point, and I'll get to how we find out about it. But the biggest mistake was that, and I don't know, obviously I don't know the facts as to how the information got passed up the line at Wells Fargo, but at some point, if there's a major problem, the CEO will get wind of it. And that is, at that moment, that's the key to everything, because the CEO has to act. That Solomon situation that you saw happened because on April, I think, 28th, the CEO of Solomon, the president of Solomon, the general counsel of Solomon, sat in a room, and they had described to them by a fellow named John Merriweather some bad practice, terrible practice that was being conducted by a fellow named Paul Moser who worked for him. And Paul Moser was flim-flamming the United States Treasury, which is a very dumb thing to do, and he was doing it partly out of spite because he didn't like the Treasury and they didn't like him, so he put in phony bids for U.S. Treasuries and all of that. So on April 28th, roughly, the CEO and all these people knew that they had something that had gone very wrong, and they had to report it to the Federal Reserve Board in New York, the Federal Reserve Bank in New York. And the CEO, John Goodfriend, said he would do it, and then he didn't do it. And he undoubtedly put it off just because it was an unpleasant thing to do. And then on May 15th, another Treasury auction was held, and Paul Moser put in a bunch of phony bids again. And at this point, it's all over, because the top management had known ahead of time, and now a guy that was a pyromaniac had gone out and lit another fire, and he lit it after they'd been warned that he was a pyromaniac, essentially. And it all went downhill from there. It had to stop when the CEO learns about it. And then they made a third mistake, actually, but again, it pales in comparison to the second mistake. They made a third mistake when they totally underestimated the impact of what they had done once it became uncovered, because there was a penalty of $185 million, and in the banking business, people get fined billions and billions of dollars for mortgage practices and all kinds of things. The total fines against the big banks, I don't know whether it totals 30 or 40 or billion or whatever the number may be. So they measured the seriousness of the problem by the dimensions of the fine. And they thought a $185 million fine signaled a less offensive practice than something involved $2 billion, and they were totally wrong on that. But the main problem was they didn't act when they learned about it. It was bad enough having a bad system, but they didn't act. At Berkshire, we have the main source of information for me about anything that's being done wrong at a subsidiary is the hotline. Now we get 4,000 or so hotline reports, or that come, we get communications on the hotline, perhaps 4,000 times a year, and most of them are frivolous. You know, the guy next to me has bad breath or something like that. I mean, but there are a few serious ones, and the head of our internal audit, Becky Amick, looks at all those people. A lot of them come in anonymous, probably most of them, and some of them she refers back to the companies, probably most of them. But anything that looks serious, you know, I will hear about, and that has led to action. We'll put them more than once, and we spent real money investigating some of those. We put special investigators sometimes on them, and like I say, it is uncovered certain practices that we would not at all condone at the parent company. I think it's a good system. I don't think it's perfect. I don't know what. I'm sure they've got an internal audit at Wells Fargo, and I'm sure they've got a hotline, and I don't know the facts, but I would just have to bet that a lot of communications came in on that, and I don't know what their system was for getting them to the right person, and I don't know who did what at any given time. But it was a huge error if they were getting, and I'm sure they were, getting some communications and they ignored them, or they just sent them back down to somebody down below. Charlie, you followed. What are your thoughts on it?
Well, put me down as skeptical when some law firm thinks they know how to fix something like this. Yeah. If you're in a business where you have a whole lot of people under incentives very likely to cause a lot of misbehavior, of course you need a big compliance department. Every big wirehouse stock brokerage firm has a huge compliance department, and if we had one, we would have a big compliance department too, wouldn't we, Warren?
Absolutely.
Absolutely. But that doesn't mean that everybody should try and solve their problems with more and more compliance. I think we've had less trouble over the years by being more careful in whom we pick to have power and having a culture of trust. I think we have less trouble, not more.
But we will have trouble from time to time.
Yes, of course. Yeah. We'll be blindsided someday.
Charlie says an ounce of prevention. He said when Ben Franklin, who he worships, said an ounce of prevention is worth a pound of cure, he understated it, that an ounce of prevention is worth more than a pound of cure. And I would say a pound of cure promptly applied is worth a ton of cure that's delayed. And problems don't go away. John Goodfriend said that problem originally was, he called it a traffic ticket. He told the troops there at Solomon it was a traffic ticket, you know, and it almost brought down a business. Some other CEO that day described the problem that he had encountered as a footfall, you know, and it resulted in incredible damage to the institution and so on. You've got to act promptly, and frankly, I don't know any better system than hotlines and anonymous letters. To me, I get anonymous letters, and I've gotten 3 or 4 of them, probably in the last 6 or 7 years, that have resulted in major changes. And very occasionally they're signed. Usually, almost always they're anonymous, but it wouldn't make any difference because there will be no retribution against anybody, obviously, if they call our attention to something that's going wrong. But I will tell you, as we sit here, somebody is doing, quite a few people are probably doing something wrong. at Berkshire, and usually it's very limited. I mean, maybe stealing small amounts of money or something like that. But when it gets to some sales practice like was taking place at Wells Fargo, you can see the kind of damage it would do. We will now shift over to the analysts and Johnny Brent.
Hi, Warren. Hi, Charlie. Thanks for having me. You've addressed the risk of driverless cars to Geico's business, but it strikes me that driverless trucks could narrow the cost advantage of railroads even if the number of crew members in a locomotive eventually declines from 2 to 0. Is autonomous technology more of an opportunity or more of a threat for the Burlington Northern?
Oh, I would say that the driverless trucks are a lot more of a threat than an opportunity to the Burlington Northern, and I would say that if driverless cars became pervasive, it would only be because they were safer, and that would mean that the overall economic cost of auto-related losses had gone down, and that would drive down the premium income of Geico. So I would say both of those, autonomous vehicles, widespread, would hurt us if they spread to trucks, and they would hurt our auto insurance business. I think my personal view is that they will certainly come. I think they may be a long way off, but that will depend. It'll probably, frankly, depend on experience in the first early months of the introduction in other than test situations. And if they make the world safer, it's going to be a very good thing, but it won't be a good thing for auto insurers. And similarly, if they learn how to move trucks more safely, tends to be driver shortages in the truck business now. It obviously improves their position vis-a-vis the railroads. Charlie?
Well, I think that's perfectly clear.
Yeah. Finally, approval. All these years. Okay. Station 1, the shareholder.
Hi, Warren and Charlie. My name is Brian Martin, and I'm from Springfield, Illinois. In the HBO documentary, Becoming Warren Buffett, you had a great analogy comparing investing to hitting a baseball and knowing your sweet spot. Ted Williams knew his sweet spot was a pitch right down the middle. When both of you look at potential investments, what attributes make a company a pitch in your sweet spot that you'll take a swing at and invest in?
Well, I'm not sure I can define it in exactly the terms you would like, but we sort of know it when we see it, and it would tend to be a business that, for one reason or another, we can look out 5 or 10 or 20 years and decide that the competitive advantage that it had at the present would last over that period, and it would have a trusted manager that would not only fit into the Berkshire culture, but that was eager to join the Berkshire culture. And then it would be a matter of price. But the main, when we buy a business, essentially we're laying out a lot of money now based on what we think that business will deliver over time. And the higher the certainty with which we make that prediction, the better we feel about it. You can go back to the first, wasn't the first outstanding business we bought, but it was kind of a watershed event, which was a relatively small company, See's Candy. And the question when we looked at See's Candy in 1972 was, would people still want to be both eating and giving away that candy in preference to other candies? And it wouldn't be a question of people buying candy for the low bid. And we had a manager we liked very much, and we bought a business that was paid $25 million for it net of cash. And it was earning about $4 million pre-tax then, and we must be getting close to $2 billion or something like that pre-tax that we've taken out of it. But it was only because we felt that people would not be buying necessarily a lower price candy. I mean, it does not work very well if you go to your wife or your girlfriend on Valentine's Day, I hope they're the same person, and say, here's a box of candy, honey, I took the low bid. It loses a little of it as you go through that speech. And we made a judgment about Zee's candy that it would be special, and probably not in the year 2017, but we certainly thought it would be special in 1982 and 1992, and fortunately we were right on it. And we're looking for more Zee's candies, only a lot bigger. Charlie?
Yeah, but it's also true that we were young and ignorant then. And
now we're old and ignorant. Yeah.
Yes, that's true too. And the truth of the matter is that it would have been very wise to buy Zee's candy at a slightly higher price. And if they'd asked it, we wouldn't have done it. So we've gotten a lot of credit for being smarter than we were.
Yeah, and to be more accurate,
yeah.
If it had been 5 million more, I wouldn't have bought it. Charlie would have been willing to buy it. So fortunately, we didn't get to the point where we had to make that decision that way. But he would have pushed forward when I probably would have faded. It's a good thing. It's a good thing that the guy came around. Actually, the seller was the grandson of Mrs. Zee, wasn't he, Charlie? Larry Zee's son. Am I correct? Or Larry Zee's brother. But he was not interested in the business, and he was more interested in girls and grapes, actually. And he almost changed his mind. Well, he did change his mind about selling, and I wasn't there, but Rick Guerin told me that Charlie went in and gave an hour talk on the merits of girls and grapes over having a candy company. This is true, folks. And the fellow sold to us, so that I pulled Charlie out in emergencies like that.
We were very lucky that early the habit of buying horrible businesses because they were really cheap. It gave us a lot of experience trying to fix unfixable businesses as they headed downward toward doom. And that early experience was so horrible, fixing the unfixable, that we were very good at avoiding it thereafter. So I would argue that our early stupidity helped us.
Yeah. We learned we could not make a silk purse out of a sow's ear.
No, we learned.
So we went around looking for silk.
But you have to try it for a long time and fail and have your nose rubbed in it to really understand it.
Okay, Becky, quick.
This question comes from a shareholder named Mark Blackley in Tulsa, Oklahoma, who says, there has been more news than usual in some of Berkshire's core stock holdings. Wells Fargo and the incentive and new account scandal. American Express losing the Costco relationship and playing catch-up in the premium card space. United Airlines and customer service issues. Coca-Cola and slowing soda consumption. How much time is spent reviewing Berkshire stock holdings, and is it safe to assume if Berkshire continues to hold these stocks that the thesis remains intact?
Well, we spend a lot of time thinking those are very large holdings. If you add up American Express, Coca-Cola, and Wells Fargo, I mean, you're getting up, well into the high tens of billions of dollars, and those are businesses we like very much. They're different characteristics. In the case of, you mentioned United Airlines, we actually are the largest holder of all four of the large. We're the largest holder of the four largest airlines, and that is much more of an industry thought. But all businesses have problems, and some of them have some very big pluses. I personally, you mentioned American Express. If you read American Express's first quarter report and talk about their platinum card, the platinum card is doing very well. The gains around the world, I think there were 17% or something like that in buildings in the UK, and 15% is the original currency, or the local currency. Japan, Mexico, and very good in the United States. There's competition in all these businesses. If we thought we did not buy American Express or Wells Fargo or United Airlines, but Coca-Cola with the idea that they would never have problems or never have competition. Why we did buy them is we thought they had very, very strong hands, and we liked the financial policies. In the case of many of them, we like their position. We bought a lot of businesses, and we do look to see where we think they have durable competitive advantage, and we recognize that if you've got a very good business, you're going to have plenty of competitors who are going to try and take it away from you, and then you make a judgment as to the ability of your particular company and product and management to ward off competitors. They won't go away, but we think, I'm not going to get into the specific names on it, but those companies generally are very well positioned. I've likened essentially, if you've got a wonderful business, even if it's a small one like See's Candy, you basically have an economic castle, and in capitalism, people are going to try and take away that castle from you. So you want a moat around it, protecting it in various ways that can protect it. And then you want a knight in the castle that's pretty darn good at warding off marauders. But they're going to be marauders, and they'll never go away. And if you look at, I think Coca-Cola was 1886, American Express was 51 or 52, starting out with an express business. Wells Fargo with, I don't know what year they were started. Incidentally, American Express was started by Wells and Fargo as well. So these companies had lots of challenges, and they'll have more challenges, and the companies we own have had challenges. Our insurance business has had challenges, but you know, we started with National Indemnity as $8 million purchase in 1968, and fortunately we've had people like Tony Nicely at Geico, and we've had G. Jane, who's added tens of billions of value, and we've got some smaller companies that you probably don't even know about, but really have done a terrific job for us. So there'll always be competition in insurance, but there'll always be things to do that a really intelligent management with a decent distribution system, various things going for them, can do to ward off the marauders. So to the specific question, how much time is spent reviewing the holdings, I would say that I do it every day. I'm sure Charlie does it every day. Charlie?
Well, I don't think I got anything to add to that either.
We'll cut his salary if he doesn't participate here. Okay, Jay Gelb.
This question is on Berkshire's retroactive reinsurance deal with AIG, which was the largest ever of its kind. Based on AIG's track record of reserve deficiencies and the opportunity for Berkshire to invest the float, what is your level of confidence that this contract covering up to $20 billion of AIG's reserves in return for $10 billion of premiums will ultimately be profitable for Berkshire?
Well, at the time we do every deal, I think it's smart. And then sometimes I find out otherwise as we go along. The deal, that Jay knows, but might be unfamiliar to many people, is that AIG transferred to us the liability for 80% of 25 billion, excess of 25 billion. In other words, they had to pay the first 25 billion, and then on the next 25 billion, we had to pay 80% of what they paid, up to a limit of 20 billion, 80% of 25. And we got paid $10.2 billion for that. And we had, and this applies to their losses in many classes of business, written or earned before December 31st, 2015. So Ajit Jain, who has made a lot more money for Berkshire than for you than I have, but he evaluates that sort of transaction. We talk about it a fair amount ourselves. I just find it interesting. I particularly find the 10.2 billion that they're going to give us interesting. And we come to the conclusion that we think we'll do well by getting 10.2 billion today with a maximum payout of 20 billion over some between now and Judgment Day on this large piece of business. AIG had very good reasons for doing this because their reserves had been under criticism, and this essentially probably it should have, I think, put to bed the question whether they were under reserved on that business. And we get the 10.2 billion, and the question is how fast we pay out the money and how much money we pay out. And Ajit does 99% of the thinking on that, and I do 1%. And we project out what we think will happen, and we know whatever our projection is that it will be wrong, but we try to be conservative. And we've done a fair amount of these deals. This is the largest. The second largest was a creature that was formed out of Lloyd's of London some years ago. And we've been wrong on one transaction that involved something over $1 billion of premium. I mean, clearly wrong. And there are a couple of others that may or may not work out depending on what you assume we have earned on the funds. But they're okay. But they probably didn't come out as well as we thought they would, though. But overall, we've done okay on this. It's less okay when we're sitting around with 90+ billion of cash. So the incremental 10.2 billion we took in the first quarter is earning us peanuts at the moment. And peanuts is not what fits into the formula for making this an attractive deal. So we do have to assume we'll find uses of the money, but the money will be with us quite a while. And I think our calculations are on the conservative side. They're not the identical calculations that AIG makes. I mean, we come up with our own estimate of payouts and all of that. And I think it was quite a good transaction from AIG's standpoint, because they did take 20 billion of potential losses off for 10.2 billion, and I think they satisfied the investing community that they were quite unlikely to have adverse development in the period prior to 2015 that was not accounted for by this transaction. Charlie?
Well, I think it's intrinsically a dangerous kind of activity, but that's one of its attractions. I don't think there are any two people in the world that are better at this kind of transaction than Ajit and Warren, and nobody else has had the experience we've had. Just get me in a lot more of those businesses, and I'll accept a little extra worry.
There's one thing I should mention too, that we actually were the only insurance operation in the world that would write that sort of a contract, and where it would be satisfactory to the other party. I mean, when somebody hands you $10.2 billion and says, I'm counting on you to pay 20 billion back, even if it's 50 years from now on the last dollar, there are very few people that they want to hand 10.2 billion to. So there's limited people on the other side. I mean, there's not that many people remotely that have that kind of size deal.
Very few is a good expression. He means one.
Yeah. Okay, we'll go to station 2.
Hello, Mr. Buffett, Mr. Munger. My name is Grant Gibson. I'm from Denver, Colorado, and this is my 5th consecutive year here, so thank you for having us.
Thanks for coming.
Appreciate it. With all due respect, Mr. Buffett, this question is for Mr. Munger. In your career of thousands of negotiations and business dealings, could you describe for the crowd which one sticks out in your mind as your favorite or as otherwise noteworthy?
Well, I don't think I've got a favorite, but the one that probably did us the most good as a learning experience was See's Candy. The power of the brand, the unending flow of ever-increasing money with no work.
Sounds nice.
It was, and I'm not sure we would have bought the Coca-Cola if we hadn't bought the Z's. I think that a life properly lived is just learn all the time. And I think Berkshire's gained enormously from these investment decisions by learning through a long, long period. Every time you appoint a new person that's never had big capital allocation experience, it's like rolling the dice. And I think we're way better off having done it so long. But the decisions blend, and the one feature that comes through is the continuous learning. If we had not kept learning, you wouldn't even be here. You'd be alive probably, but not here.
There's nothing like the pain of being in a lousy business to make you appreciate a good one.
Well, there's nothing like getting into a really good one. That's a very pleasant experience, and it's a learning experience. I have a friend who says, the first rule of fishing is to fish where the fish are. And the second rule of fishing is to never forget the first rule. And we've gotten good at fishing where the fish are.
Yeah, that's only metaphorically. I went to fish with Charlie one time.
There are too many other boats in the damn water, but the fish are still there.
Yeah, we bought a department store in Baltimore in 1966, and there's really nothing like being in the experience of trying to decide whether you're going to put a new store in an area that hasn't really developed yet enough to support it, but your competitor may move there first, and then you have the decision of whether to jump in, and if you jump in, that kind of spoils it. Now you got two stores where even one store isn't quite justified. How to play those games, those business games, you learn a lot by trying, and what you really learn is which ones to avoid. I mean, if you just stay out of a bunch of terrible businesses, you're off to a very great start, because we've tried them all.
But you can really learn because the experience is a lot like eating cockleburgers, and it really gets your attention.
Well, we won't expand on that. Andrew Ross Sorkin.
Good morning, Warren. This question comes from a longtime shareholder who, I should tell you, accosted me last night in the lobby of the Hilton Hotel with this question. Warren, for years you stayed away from technology companies, saying they were too hard to predict and didn't have moats. Then you seemed to change your view about technology when you invested in IBM, and again when you recently invested in Apple. But then on Friday you said IBM had not met your expectations and sold a third of our stake. Do you view IBM and Apple differently? And what have you learned about investing in technology companies?
Well, I do view them differently, but obviously, when I bought the IBM, started buying it 6 years ago, I thought it would do better in the 6 years that have elapsed than it has. And Apple, I regard them as being a quite different business. I think Apple was much more of a consumer products business in terms of in terms of sort of analyzing moats around it and consumer behavior and all that sort of thing. It's obviously a product with all kinds of tech built into it, but in terms of laying out what their prospective customers will do in the future as opposed to, say, on IBM's customers, it's a different sort of analysis. That doesn't mean it's correct, and we'll find out over time, but they are two different types of decisions, and I was wrong on the first one, and we'll find out whether I'm right or wrong on the second. But I do not regard them as apples and apples, and I don't quite regard them as apples and oranges, but it's somewhat in between on that. Charlie?
Well, we avoided the tech stocks because we felt we had no advantage there, and other people did. And I think that's a good idea, not to play where the other people are better. But if you ask me, in retrospect, what was our worst mistake in the tech field? I think we were smart enough to figure out Google. Those ads worked so much better in the early days than anything else. So I would say that we failed you there. And we were smart enough to do it and didn't do it. We do that all the time too.
Yeah, we were their customer very early on with Geico, for example, and we saw, these figures are way out of date, but as I remember, we were paying them $10 or $11 a click or something like that. And anytime you're paying somebody 10 or 11 bucks every time somebody just punches a little thing where you've got no cost at all, that's a good business unless somebody's going to take it away from you. And so we were close up seeing the impact of that. And incidentally, if any of you don't have anything to do in your hotel rooms tonight, just keep punching Progressive or something, and you can don't really do that. The thought just happened to cross my mind. But that is, you've never seen a business, almost never seen a business like it, where and I think for LASIK surgery and things like that, I think the figures were, 60 or 70 bucks a click with no incremental, no cost. So, and I knew the guys. I mean, they actually designed their prospectus. They came to see me, and a little bit after the original one, when they went public, a little bit after Berkshire even. And so I had plenty of ways to ask questions or anything of the sort and educate myself, but I blew it.
We blew Walmart too. When it was a total cinch, we were smart enough to figure that out, and we didn't.
Yeah, figuring out execution is what counts. So, anyway, and I could be making two mistakes on IBM. I mean, it's harder to predict, in my view, the winners in various items, or how much price competition will enter in to something like cloud services and all that. I made a statement the other day, which it's really remarkable, and I was asked Charlie whether he could think of a situation like it, where one person has built an extraordinary economic machine in two really pretty different industries, almost simultaneously, as has happened.
From a standing start at zero.
From a standing start at zero with competitors with lots of capital and everything else, to do it in retailing and to do it with the cloud, like Jeff Bezos has done. I mean, people like the Mellons invested in a lot of different industries and all of that, but he has been in effect the CEO simultaneously of two businesses starting from scratch. That if Andy Grove at Intel used to say, think about if you had a silver bullet and you could shoot it and get rid of one of your competitors, who would it be? Well, I think that both in the cloud and in retail, there are a lot of people that would aim that silver bullet at Jeff, and he's done it's a different sort of game. But he's, at the Washington Post, he's played that hand as well as anybody I think possibly could. So it's a remarkable business achievement where he's been involved actually in the execution, not just bankrolling it, of two businesses that are probably as feared by their competitors almost as any you can find. Charlie, you got further thoughts?
Well, we're sort of like the Mellons, old-fashioned people who've done all right. And Jeff Bezos is a different species.
And we missed it entirely, incidentally. We never owned a share of Amazon. Okay, Greg Warren.
Warren, my question relates to some recent stock purchases as well. Unlike the railroads, which benefit from colossal barriers to entry due to their established, practically impossible to replicate networks of rail and rights-of-way, the airline industry seems to have few, if any, advantages. Even with the consolidation we've seen during the past 15 years, the barriers to entry are few and the exit barriers are high. The industry also suffers from low switching costs and intense pricing competition and is heavily exposed to fuel costs, with rising fuel prices being difficult to pass on and declining fuel prices leading to more price competition. Compare this with rail customers who have few choices and thus wield limited buying power, and where fuel charges allow the industry to mitigate fuel price fluctuations. While you've noted several times since the airline stock purchases were announced that the two industries are quite different and that comparisons should not be made to Berkshire's move into railroads a decade ago, could you walk us through what convinced you that the airlines were different enough this time around for Berkshire to invest close to $10 billion in the four major airlines? Because it would seem to me that UPS, which you have a small stake in, and FedEx, both of which have wider economic moats built on more identifiable and durable competitive advantages, would be a better option for long-term investors.
Yeah, the decision in respect to airlines had no connection with our being involved in the railroad business. I mean, you can classify them in, maybe in as transportation business or something, but it had no connection, no more connection than the fact we own Geico or any other business. You couldn't pick a tougher industry, ever since Orville went up, and I said, that if anybody had really been thinking about investors, they should have had Wilbur shoot him down and saved everybody a lot of money for 100 years. You can go to the internet and type in airlines and bankrupt, and you'll see that something like 100 airlines in that general range, gone bankrupt in the last few decades. And actually, Charlie and I were directors for some time of US Air, and people write about how we had a terrible experience in US Air. It was one of the dumbest things I've ever done. And there's a lot of
made a fair amount of money out of it, too.
Yeah, and we made a lot of money out of it.
It's undeserved.
But we made a lot of money out of it because there was one little brief period when people got all enthused about US Air. And after we left as directors and after we sold our position, US Air managed to go bankrupt twice in the subsequent period. I mean, you've named all of the, not all of them, but you've named a number of factors that just make for terrible economics. And I will tell you that if capacity, it's a fiercely competitive industry. The question is whether it's a suicidally competitive industry, which it used to be. I mean, when you get virtually every one of the major carriers and dozens and dozens and dozens of minor carriers going bankrupt, it ought to come upon you finally that maybe you're in the wrong industry. It has been operating for some time now at 80% or better of capacity being available seat miles, and you can see what deliveries are going to be and that sort of thing. So if you make I think it's fair to say that they will operate at higher degrees of capacity over the next 5 or 10 years than the historical rates, which caused all of them to go broke. Now the question is whether, even when they're doing it in the 80s, they will do suicidal things in terms of pricing. Remains to be seen. They actually, at present, are earning quite high returns on invested capital. I think higher than either FedEx or UPS if you actually check that out. But that doesn't mean tomorrow morning, if you're running one of those airlines and the other guy cuts his prices, you cut your prices. And as you say, there's more flexibility when fuel goes down to bring down prices than there is to raise prices when prices go up. So the industry, it is no cinch that the industry will have some more pricing sensibility in the next 10 years than they had in the last 100 years. But the conditions have improved for that. They've got more labor stability than they had before because they're basically all going to, they've been through bankruptcy and they're all going to sort of have an industry pattern bargaining, it looks to me like. They're going to have a shortage of pilots to some degree, but it's not like buying See's candy. Charlie?
No, but the investment world has gotten tougher with more competition, more affluence, and more absolute obsession with finance throughout the whole country. And we picked up a lot of low-hanging fruit in the old days where it was very, very easy and we had huge margins of safety. Now we operate with a less advantageous general climate, and maybe we have small statistical advantages where in the old days it was like shooting fish in a barrel. But that's all right. It's okay if it gets a little harder after you get filthy rich.
Charlie's more philosophical than I am on that point. So,
well, I can't bring back the low-hanging fruit, Warren. You're just going to have to keep reaching for the higher branches.
Greg, I think the odds are very high that there are more revenue passenger miles 5 years from now or 10 years from now. If the airlines, if the airline companies are only worth 5 or 10 years from now what they're worth now in terms of equity, we'll get a pretty reasonable rate of return because they're going to buy in a lot of stock at fairly low multiples. So if the company's worth the same amount at the end of the year and there's fewer shares of stock outstanding, over time we make decent money, and all 4 of the major airlines are buying in stock at a...
You got to remember that the railroads were a terrible business for decades and decades and decades, and then they got good.
Yeah, I like the position. Obviously, by buying all 4, it means that it's very hard to distinguish who will do the, at least in my mind, it's hard to distinguish who will do the best. I think the odds are quite high that if you take revenue passenger miles flowing 5 or 10 years from now, it will be a higher number, and that will be, there'll be low-cost people to come in, and the Spirits of the world and JetBlues, whatever it may be. But my guess is that all 4 of the companies we have will have higher revenues. The question is what their operating ratio is. They will have fewer shares outstanding by a significant margin. So even if they're worth just what they're worth today, we could make a fair amount of money, but it is no cinch by a long shot. Okay, station 3.
Good morning, everybody. My name is Sibylle Arians. I'm from Germany, and I'm member of board of Ethicon Foundation, Ethics and Economy. I'm very happy that I can put my question here, and maybe you are not as happy as I am to listen to it.
Well, we'll try to stay happy. Thank you for coming.
Thank you. Mr. Buffett, a few years ago, I saw a movie in which you proclaimed that the print of the dollar bill, "In God We Trust," does not really oppress your philosophy. In your opinion, only cash counts, and your credo is, "In the dollar I trust."
I don't think I've ever said that, actually, but...
well, I can show you the movie. That will prove.
Oh, well,
well,
send me a clip.
Maybe it was just joking, but always behind a joke there is also a truth. So, well, you laughed heartily at that moment. You, as one of the most richest men of all times on this earth, a good-humored, friendly, elderly gentleman. Whatever motivated those who designed the dollar notes, they certainly wanted to say that there is something higher than the value of this printed paper. Regrettably, you have shown many times in your life that you see this differently. You have accumulated billions of dollars, showed extraordinary cleverness and skill, and you know better to pick up than many others who, like you, use the rules which are inherent to capitalism for their own intentions. But have you ever given a thought to what troubles and sacrifices, slavery and destruction of Mother Earth, and even diseases and deaths stick to the dollar bills, which you gather so eagerly? Let's take Coca-Cola. Ethicon Foundation, Ethics and Economy from Germany has awarded the Black Planet Award to the members of the board of directors as well as to the large shareholders, Warren Buffett and Herbert Allen, because you are co-responsible for all of what makes this group make so much money, isn't it? Among other things, Coca-Cola deprives people of their drinking water in drought-prone areas of the world.
Are you asking a question?
Contaminate the groundwater in these areas.
I don't want to interrupt you, but are you making a speech or asking your question?
I put my question right now.
Okay, good.
Will you give up your Coca-Cola shares if the destruction of the environment, the monopolization of the right to healthy drinking water, and the shameless exploitation of the workers continue?
Well, that's more of a speech than a question.
Yeah. I don't think that quote you had earlier. I've said once or twice that it should say in the Federal Reserve we trust, because they print the money, and if they print too much of it, it could decline in value. But I have never, to my knowledge, I've never said anything like you originally said. And I would say this: I think I've been eating things I like to eat all my life, and Coca-Cola. This Coca-Cola is 12 ounces. I drink about 5 a day. It has about 1.2. It has about 1.2 ounces of sugar in it. And if you look at what different people get their sugar and calories from, they get them from all kinds of things. I happen to believe that
वॉरेन बफे और चार्ली मुंगर वाइस चेयरमैन और चेयरमैन सीईओ बर्कशायर हैथवे के 53वीं एजीएम चल रही है इस समय ओमाहा के नेब्रास्का में। ये 53वीं एजीएम है। करीब 30,000 से ज़्यादा निवेशक इस एजीएम में हिस्सा ले रहे हैं। तमाम सवालों के जवाब दे रहे हैं वॉरेन बफे। और शुरुआत में उन्होंने ये एथिकल कॉरपोरेट कल्चर की बात उन्होंने कही, और उन्होंने इंट्रिंसिक वैल्यू की बात कही। उन्होंने कहा ये हमारे लिए ज़्यादा इम्पॉर्टेंट है।
Maybe you'd encourage the government to ban sugar, but sugar in Coca-Cola is not different than eating sugar, put on my grape nuts in the morning or whatever else I'm having. I think Coca-Cola's been a very, very positive factor in America and the world for a long, long time, and you can look at a
तो
and I've been doing it for just as long as you've been taking all those Coca-Colas that are. I've had breakfast with Warren when he has Coca-Colas and nuts, and
pretty damn good too.
Yeah, if you keep doing that, Warren, you may not make 100.
Well, I think there's something in longevity to feeling happy about your life too.
Absolutely.
Okay, Carol.
This question is from Franz Tromberger of Austria, and it concerns intrinsic value, which is neither, Warren may amend this, my definition here, but which is neither a company's accounting value nor its stock market value, but is rather its estimated real value. So the question is, at what rate has Berkshire compounded intrinsic value over the last 10 years, and at what rate, including your explanation for it, please, do you think intrinsic value can be compounded over the next?
तो बर्कशायर हैथवे की अभी भी एजीएम चल रही है।